Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 1-1. This is Paper 1, which consists of 30 multiple choice questions, and the total time limit for this paper is 1 hour. So in this video as well, we'll be attempting to complete this paper within 1 hour. Without any further delay, let's get started. For the first question, which statements are true of a bank overdraft? Remember that bank overdraft is part of our current liability. It just means that our bank balance has a negative amount, and it will occur when we withdraw a higher amount as compared to what we have within our bank account. And of course, since it's a current liability, it will be a source of short-term finance. Now, for the first one, we have it is long-term finance. It is incorrect, as we have already established that since it is a current liability, it will be of short-term in nature. So 2 will be correct. Then it is of a fixed amount. It is incorrect because, like I said, bank overdraft is when we withdraw a higher amount as compared to what we have within our account. And the difference between the amount that is taken out of the bank account and whatever balance we have is going to act as a bank overdraft. So that could be of any amount. There is no fixed amount. So it will be a variable amount, but up to a certain limit, because there will be a maximum limit up to which you can withdraw from your bank account as part of the bank overdraft. So 4 will be correct. The answer we're looking for should include 2 and 4, which is given by option D. That is all for the first question. Let's move towards the second one. Marcus bought a non-current asset. Instead of paying in full, he decided to pay in installments over the next 6 months. What was the effect of his decision during the next 6 months? The first one is that the bank overdraft was lower. This will be true because in this case, instead of paying in full, he will be paying in installments. So he will not have to withdraw a large amount from his bank account at once. If he were to pay in full, then it would mean that he would have to withdraw a higher amount. That will be the total cost of the non-current asset. And that would make our bank overdraft to be lower. But in this case, since he decided to pay in installments, he will only have to withdraw a certain amount. Let me give you an example. Let's say the cost was 50,000. And the installment will be 10,000, maybe 10,000 per month. So if he were to pay in full, he would have to withdraw a total amount of 50,000. So the bank balance would be lower by 50,000, which means that the bank overdraft would be higher. But since we will only be withdrawing 10,000, that is a certain amount of the total cost, the bank overdraft will be lower, because although it will reduce the bank balance, it will not reduce it by such a high amount. So in this case, the answer will be option A. Let's go over the other options as well. Current ratio was higher. Okay, we know that current ratio is just going to be current asset over current liabilities. And since he will be paying in installments, the bank balance will be reduced by a lower amount. Since the current asset is reduced by a lower amount, if we were only to take a look at the numerator part, then the current ratio would be higher. But in this case, remember that the current liability will also increase. If out of 50,000, we are only paying 10,000 right now, then the remaining payable is 40,000. Payables will be part of our current liabilities, so the denominator factor will increase, which in turn will lower the total ratio. So the current ratio being higher is incorrect. Then liquidity was worse. Liquidity is our cash position of the business. In this case, the liquidity will be better because we will only be using a lower amount out of our total cash. So this is also incorrect. Then the fourth one is our non-current liabilities were greater. In this case, we are not talking about any sort of non-current liabilities. We are only talking about acquiring or buying a new non-current asset. So this has no impact over our non-current liabilities. So D will be incorrect. That is all for the second question. Let's move towards the next one. A business sells a non-current asset for cash. The disposal account includes entries for the cost of the asset and the sales proceeds. Which book of prime entry are used? Okay, when we are talking about disposing a particular non-current asset, it means that the cost of that non-current asset should no longer be included within our books of accounts. So the cost of asset will be recorded within our general journal, because remember, cash book will record all of the transactions related to cash. But in this case, since we are just removing the cost of the asset, we are not talking about any cash inflow or cash outflow. So cash book will be incorrect. And purchases journal will only record about our credit purchases. which has no relation to the cost of the asset in this case. So the correct one would be general journal. And then for the sales proceeds refers to the amount that we get by selling the non-current asset, and we are selling it for cash, which means that this will result in part of our cash inflow. Cash inflows should be recorded within our cash book. So that is given by C and D. Overall, the correct option is given by C. That's the answer. Let's move towards the next question. The owner of a business received an order from a customer on the last day of the financial year, 31st December, and dispatched the goods on the same day. So the owner gave the goods to the customer on the same day, which is the date of 31st December. The goods were invoiced to the customer a few days later on 3rd January. Which accounting concept should be applied when deciding whether to record the sale on 31st December or 3rd January? Remember, the sale occurred during the current year, even though it was the last day of the financial year. And what the realization concept states is that we need to record the revenue when it is earned, regardless of whether the goods has been paid for or not. And that is the concept we need to apply when deciding whether to record the sale on 31st December or 3rd January, which is given by option D. That's all for the first question. Let's move towards the next one. Details regarding the purchase of a non-current asset are as follows. We have the cost of new machine, expected residual value, installation cost of new machine, cost of inventory for use in new machine. Which amount was recorded as capital expenditure for the new machine? Remember, capital expenditure is non-recurring in nature. It means that it does not occur very frequently. Now, the first one is cost of new machine. The cost of any non-current asset should always be part of our capital expenditure. So we can start with this 20,000. Then we have expected residual value. Expected residual value is the amount that we might get at the end of the non-current asset's lifetime by selling it. So this has no relation to our capital expenditure, since it will only be used while calculating the depreciation charge for the year. So we can ignore this for now. Then we have installation cost of new machine. Remember that the machine only needs to be installed once. So that is non-recurring in nature. It will only occur once. It does not occur frequently, which is why this is to be a part of our capital expenditure. So we can add the 3,000. Then we have the cost of inventory for use in new machine. So these are the inventories that will be used within this new machine. But remember, this will be recurring in nature, because after we finish the current lot of inventory, we will have to purchase it again during the same year. So the nature for this cost of inventory will be recurring, which is part of our revenue expenditure, not the capital expenditure. So we can ignore this, which means that the total capital expenditure is just going to be 23,000. That is the answer we're looking for, which is given by option C. That's all for the fifth question. Let's move towards the next one. Now, a depreciated non-current asset is revalued upwards. What is the effect of this? Whenever there is revaluation upwards, that will be recorded within our revaluation reserve. And revaluation reserve is a part of our capital reserve. So it means that the capital reserve will increase, which is given by option B. Then, as for the revenue reserve, there will be no effect, because we do not record any revaluation upwards and revaluation downwards within our statement of profit or loss. And remember, revenue reserve, the main revenue reserve is just going to be our retained earnings, which is the accumulation of profit. Since no records are to be made within our statement of profit or loss, there will be no impact within the profit for the year. And as a result, there will be no impact within our revenue reserve. So it's given by A and B. Overall, the correct answer is given by option B. That's all for the sixth question. Let's move towards the next one. A business depreciates its non-current assets at 20% using the straight line method. It means that we apply this rate of 20% to the cost of the non-current asset for each year. Then depreciation is calculated on a time basis in the year of acquisition and disposal. It means that we need to charge depreciation for each month it has been used during the year of acquisition as well as during the year of disposal. Now we have non-current assets at cost 31st December. This is previous year 31st December, which means that this value of 200,000 is the opening balance. So this is the opening cost of the existing non-current assets. Then we have purchase of machinery, current year, 1st January. So this is the cost of the purchase. Then we have disposal of machinery, 30 September, current year. Alright, then we have non-current assets at cost at the date of 31st December, current year. So this is the closing balance of our cost. Now we need to figure out the depreciation charge for non-current assets for the year ended 31st December. Okay, so it will be easier if we categorize the assets. So we can categorize it in three different ways. The first one will be our disposed assets. Then we have existing assets except for disposal. And then we have the new purchased asset. So we can calculate the depreciation for these three types of assets separately. Let's start with the disposed asset. We can see that the disposal of machinery took place at the date of 30 September. So the months in which it was used during the current year is going to be January, February, March, April, May, June, July, August, and September. So that will be 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 months. We used these disposed machinery during the year for 9 months. It means that we need to charge the depreciation for 9 months. So we can start with the cost. The cost is 40,000 and we are implementing a straight line method, which means that we can just multiply this rate of 20% to the cost. So times 20%, this will give us the total depreciation for the year, but we only want it for 9 out of the 12 months. This gives the value of 6,000. Now we need existing except disposed asset. So we have the opening balance of the existing non-current assets, and out of this value of 200,000, machinery costing 40,000 was disposed. So we need to exclude the disposed part. This results in 160,000. So we only need to calculate the depreciation on these assets. So that will be 160,000, the cost. Then we just multiply it by the rate of 20%, since these assets were used for the entire year during the current year. This results in the value of 32,000. Now for the purchased machinery, it was purchased at the date of 1st January, which means that we used it for the entire 12 months. So that will just be the cost of 50,000 times the rate of 20%. This results in the value of 10,000. Now we just need to combine these values. So we have 6,000 for the disposed non-current asset, then we have 32,000 for the existing non-current asset apart from the disposed one, then we have 10,000 for the newly purchased non-current assets. This results in the value of 48,000. That is the answer we're looking for, which is given by option B. That's all for the 7th question. Let's move towards the next one. The following errors were found after a suspense account was opened. Which errors would be entered in the suspense account? Okay, for the first one, a cash purchase of goods for resale for 450 had been completely omitted from the books. So this is the error of omission. Remember that error of omission will not be reflected by the preparation of trial balance, which means that this will not affect the suspense account. This will not be entered within the suspense account. Then for the second one, a payment for electricity was debited in the electricity account as 2,500 instead of 5,200. This is the error of transposition. We needed to include the amount of 2,500, but instead we flipped the 2 digits and entered the amount of 5,200. Error of transposition will be disclosed by the preparation of trial balance, which means that this will be entered in the suspense account. This is correct. Then discounts allowed of 50 had been debited to the discounts received account. Remember that discount allowed is part of the expenditure, and expenditures are to be recorded on the debit side. In this case, it had been recorded on the debit side just under the incorrect account. So it means that the trial balance total on the debit side as well as the credit side will not be affected by this error, because we entered the amount on the correct side, but only the heading was incorrect. So this will not impact our suspense account. Then motor repairs of 400 were credited to the motor vehicle at cost account. Motor repair is part of our expenditure. Motor vehicle is part of our asset. Remember that these two are different class. Since we have made the mistake of entering it in a different class, it usually is for error of principle, and error of principle will not be disclosed by the preparation of trial balance. So this should not have affected the trial balance or the suspense account, but in this case there is another major error which was to be credited. Both expenses as well as assets should be recorded on the debit side, but instead it was recorded on the opposite side, which means that the total of the trial balance debit and credit side will be affected due to this error, and as a result we need to enter it within the suspense account. So 4 is correct. The answer we're looking for should include 2 and 4, which is given by option C. That's all for the 8th question. Let's move towards the next one. A business is preparing a bank reconciliation statement. The following information is available. What is the debit balance on the bank statement? Okay, we have the cash book balance, we have unpresented checks, we have uncleared lodgements. We normally start with our balance as per the bank statement for bank reconciliation statement. Then we add our uncredited deposits, subtract the unpresented checks, and get the balance as per the cash book. So cash book balance is given right here, 7650, and this is credit. Remember that for the cash book, credit balances will be negative balances. So we have 7650 negative. Then we have unpresented checks of 2950. It should be subtracted. Then we have uncleared lodgements, which is equivalent to uncredited deposits. So we need to add these 3450. This is what we're trying to figure out. So we can just create an equation for this. We have bank statement value plus 3450 minus 2950, and this will be equal to minus 7650. So it means that the bank statement balance will be negative 7650. This will go to the other side as positive, so plus 2950. This will go to the other side as negative, so minus 3450. This results in negative 8150. And negative is correct because we want the debit balance on the bank statement. On the bank statement, debit values represents the negative amounts. So we have negative 8150. That is the answer we're looking for, which is given by option C. That's all for the 9th question. Let's move towards the next one. Which sources of information will be required to prepare a sales ledger control account? Okay, remember that sales ledger control account will be prepared based on our books of prime entry. And there are 6 different books of prime entry. That will be our sales journal, sales returns journal, purchases journal, purchase returns journal, cash book, and general journal. Okay, so we have cash book. That is true, it will be used. Then we have general journal, which is also part of the books of prime entry. So this is correct. And then we have sales and sales returns journal, which is again part of books of prime entry. So the answer we're looking for should include all 1, 2, and 3, which is given by option A. That's all for the 10th question. Let's move towards the 11th one. The opening balance on a purchases ledger control account was 18,400. The following errors or omissions were then discovered. What was the corrected balance on the purchases ledger control account? Okay, like I said before, control accounts will be prepared based on the books of prime entries. So any errors within the books of prime entries should also be corrected within the purchases ledger control account. I'm just going to prepare it roughly right here. Remember, purchase ledger control account is the trade payables account, which is a liability. For liabilities, the opening balance will be recorded on the credit side. So the opening balance of 18,400 will be right here. And within the credit side, we include items which will increase the value of trade payables, and within the debit side, we include items which will reduce the value of trade payables. For the first error, a supplier's invoice for 860 had been entered as 680 in the purchases journal. This is an error within our book of prime entry, right? Instead of 860, we recorded 680, which means that the purchases value was understated and understated by the difference. So that is 860 minus 680. So the purchases value was understated by 180, and this is the credit purchases. Credit purchases will increase the value of trade payables. And since 180 was previously not recorded on the credit side, we now need to record it there. That's all for the first error. For the second one, an item for 250 in the purchases returns journal had been credited to the supplier's account. Remember, this is an error to the individual supplier's account. This would affect our purchases ledger, not the purchases ledger control account. So we can completely ignore this for now. For the third one, discounts received of 400 had been credited to the purchases ledger control account. Remember that discounts received is something that will reduce the value of trade payables. So it should have been included on the debit side, but it was previously included on the credit side. So what we want is 400 on the debit, but we previously have 400 on the credit. Now, in order to make it look like this, if we just enter 400 once on the debit side, it will get cancelled out with the previous error. So we need to enter it again so that we can show the correct value of discounts received on the correct side. It means we now need to enter a total of 800 on the debit side as part of the discounts received. Once for it to cancel out with the amount entered on the credit side, and once for it to show the actual amount of discounts received. So it will be 800 right here. Then it had been agreed to set off 150 owing to a customer against their account in the sales ledger. So this is contra. Contra will always reduce the value of both the trade payables and the trade receivables because the customer is also a supplier. So instead of paying back and forth, we just decide to cancel it off or set off. And then no entries have been made to the sales or purchases ledger control accounts. So it will be on the reduction side, which is the debit side. We just need to record 150 right here. Now the closing balance will be here. So let us calculate the total from the credit side. That will be 18,400 plus 180, which results in 18,580. Now the closing balance will just be 18,580 minus 800 minus 150, which results in the value of 17,630. This is the answer we're looking for, which is given by option A. That's all for the 11th question. Let's move towards the next one. What is the purpose of financial statements? To aid the managers in running the business. That is true because financial statements will provide a lot of information regarding the operations or day-to-day activities of the business. It will show us the profit, it will show us the incomes, it will show us the expenses. So in order for a manager to take a decision, they will have to refer to the financial statements. If the profit is really low, it means that the expenditure is higher, so they need to cut down on some expenses. So it will help the managers in running the business. That is the correct answer. Let's look at the remaining options as well. To allow the owner to take drawings. In order to take drawings, you do not actually have to refer to the financial statements. So this is incorrect. To ensure a profit is made, remember that the preparation of financial statements will not ensure that the business will make a profit. A profit will only be made if the business has enough markup or maybe lower expenses as compared to their revenue. So this is incorrect. And the last one is to ensure accuracy of the double entry. Accuracy of the double entry cannot be measured by preparing financial statements. So this is incorrect as well. That's all for the 12th question. Let's move towards the next one. A business owner provided the following information at the end of his first year of trading. Since this is the first year of trading, there will be no opening balances for anything. Now we need to figure out the gross profit for the year. We have our closing inventory, we have the total payments to suppliers, we have the amount owing to suppliers, total receipts from customers, and amount owed by customers. Okay, so in order to calculate our sales value, we need to prepare the sales ledger control account. Since this is the first year of trading, there will be no opening balance. And remember, sales ledger control account is our trade receivables account. So anything that will increase the trade receivables will go on the debit side. Anything that will decrease the trade receivables will go on the credit side. So the credit sales should be included here. This is what we are trying to figure out. Then we have the total receipts from the customers. So once we receive the money from our credit customers, the trade receivables value will decrease. So this 85,000 will go on the credit side. Then we have the amount owed by customers. This is the closing balance of our trade receivables. Since trade receivables is an asset, the opening balance will be on the debit side and the closing on the credit side. So we have 10,000 here. Now for our credit sales, we need the total from this side, which is 95,000. And the sales value will also be 95,000. Now we repeat the same process but for purchases ledger control account. Now, purchases ledger control account is the trade payables account, which is a liability. It means that anything that will increase the value of trade payables will be on the credit side. Anything that will decrease the value of trade payables will be on the debit side. And there will be no opening balance for this one as well. And in this case, the credit purchases will be recorded on the credit side. That is what we are trying to calculate. We have our total payments to suppliers. So once we pay to the suppliers, the value of our trade payables will decrease. So this will go on the debit side. Then amount owing to suppliers. This is the closing balance of the trade payables. Since trade payables is our liability, the opening balance would be recorded on the credit side and the closing balance on the debit side. So we have 5,000 here. Now the total from this side will be 65,000. And since we have nothing else on the credit side, the credit purchases will also be of 65,000. Okay, so we have our revenue 95,000. Now in order to calculate the gross profit, we just need the cost of sales, right? Normally cost of sales will be our opening inventory plus purchases minus closing inventory. In this case, there are no opening balances, so there will be no opening inventory. We just calculated the purchases to be of 65,000. Then we have the closing inventory of 15,000. So our cost of sales is just going to be 50,000. Now we can calculate the gross profit. It is just the revenue minus the cost of sales. Revenue, we calculated it to be 95,000. Then we have the cost of sales to be 50,000. This gives us the gross profit to be 45,000. This is the answer we're looking for, which is given by option D. That's all for the 13th question. Let's move towards the next one. Lou had the following capital account balances. We have end of year 1 and end of year 2. During year 2, the following took place. So in this case, we can consider the end of year 1 value to be the opening balance and end of year 2 value to be the closing balance. Okay, during year 2, the following took place: cash drawings of 33,000 and personal motor vehicle introduced to the business at a value of 24,500. Expenses for the year include a payment for rent of 10,000, of which 40% was for Lou's personal use. So if it is for his personal use, then it will also be a part of the drawings. Let's calculate the amount. That will be 40% of 10,000. So 10,000 times 40%. This results in the value of 4,000. We need to calculate his profit for year 2. Okay, so we can just create a capital account roughly. For capital, all of the increasing factors will go on the credit side along with the opening balance, and all of the decreasing factors will go on the debit side. So we have the opening balance 45,700. Profit is something that will increase his capital balance. So we have profit. Then drawings is something that will have to be reduced from his capital account balance. So we need to reduce this 33,000 that goes on the debit side. Then we have additional drawings of 4,000 that will also go on the debit side. Then personal motor vehicle was introduced to the business. So this is just additional capital introduced. That will definitely increase his capital. So it will have to be recorded on the credit side. We have 24,500. Then we have the closing balance. Since the opening balance was recorded on the credit side, the closing balance will go on the debit side. So 63,400. Now we need to calculate the total from our debit side in order to get the value for the profit. So we have 33,000 plus 4,000 plus 63,400. This results in the value of 100,400. Now the profit will just be 100,400 minus 24,500 minus 45,700. This results in the value of 30,200. This is the answer we're looking for, which is given by option D. That's all for the 14th question. Let's move towards the next one. A business maintains an allowance for irrecoverable debts of 2% of trade receivables. At the beginning of the financial year, on 1st January, the trade receivables total was 48,000. At the end of the financial year, on 31st December, the trade receivables total was 37,000. When the business owner prepared the statement of profit or loss for the year ended 31st December, an irrecoverable debt of 1,600 which had occurred during the year had not been written off. Since this was during the year, this will reduce the value of the closing trade receivables. We have the closing trade receivables right here. So we need to reduce the irrecoverable debt of 1,600. So the revised value of the trade receivables at the year end will be 35,400. No adjustment had been made to deal with the allowance for irrecoverable debts at 31st December, by which amount was the profit for the year overstated. Okay, there are two different errors. The first thing is the irrecoverable debt was not adjusted. Then we did not make any allowance for irrecoverable debts as well. So since the expense of 1,600 was not included, expenses was understated by 1,600. So as a result, the profit will now be overstated by 1,600. That is the impact for the irrecoverable debt error. Now we also need to figure out the error for allowance for irrecoverable debts. So we need to calculate the opening balance for the allowance. And whenever we are calculating the allowance for irrecoverable debts, it is just going to be the rate times the trade receivables. So at the opening date, we have the trade receivables of 48,000. So the opening balance for allowance will be 48,000 times 2%, which results in the value of 960. Now we repeat the same process for the closing balance. At the closing date, we have the revised trade receivables of 35,400. So 35,400 times 2%. This results in the value of 708. We can clearly see that there has been a decrease. So the decrease will be of 960 minus 708, which results in the value of 252. Remember that if there is a decrease in the allowance for irrecoverable debt, it should be treated as part of our income. But this income was not included, so income was understated. So as a result, profit will also be understated by 252. So it was overstated by 1,600 due to the error of irrecoverable debt, but due to the error of the allowance for irrecoverable debt, it was understated by 252. So as a result, there was a net overstatement by the amount of 1348. Since this is a positive amount, it refers to overstated. That is the answer we're looking for, which is given by option B. That's all for the 15th question. Let's move towards the next one. Anne and Margaret have formed a partnership but not made a partnership agreement. Which statement is correct for this situation? Any loan made to the partnership by a partner will carry interest at the rate of 5% per annum. This is true in case of no partnership agreement. This is stated by the Partnership Act, which is a part of the syllabus. So if there is no partnership agreement, there are a couple of rules. The first one is that the profits and losses will be shared equally. Second one is that there will be no interest on capital. Third one is that there will be no interest on drawings. Fourth one is that there will be no salary. And fifth one is that if the partner is providing loan to the partnership, then the interest on that loan will be at the rate of 5%. That is given by A, which is why A is the correct option. Let's look at the other as well. Interest will be charged on drawings. Like I said before, no interest will be charged on drawings. So this is incorrect. Partners will be entitled to interest on capital. Again, like I said before, there should be no interest on capital. Partners will be entitled to salaries. Like I said before, there will be no salaries. So this is incorrect as well. That's all for the 16th question. Let's move towards the next one. P and Q are in partnership sharing profits and losses equally. Following information is available in respect of P. We have current account, credit balance at the start of the year, share of asset evaluation, drawings. The total partnership profit for the year was 130,000. Partnership salaries were P 20,000, Q 30,000. What was the balance on the current account of P at the end of the year? Let's prepare the current account right here. We'll just prepare it roughly. So anything that will increase his current account balance will go on the credit side. Anything that will decrease his balance will go on the debit side. We have the opening balance on the credit side, 20,150. We have share of asset evaluation. So this is a profit on revaluation, and remember, profit on revaluation is not recorded within the current account. It will be recorded within the capital account. So this is irrelevant for now. Then we have drawings. Drawings is something that will reduce the current account balance. So it will go on the debit side, 10,200. Then we have profit. And remember, profit for the year is not shared. The residual profit will be shared. How we calculate the residual profit is we start with profit for the year. We then subtract the interest on capital, because this will be paid to the partners by the partnership. Then we add the interest on drawings, because this will be paid to the partnership by the partners. Then we subtract our salary, and then we get the residual profit. So we need to calculate the residual profit. We have profit for the year of 130,000. We do not have any information regarding interest and drawings, but we do have salaries. For P, it was 20,000. For Q, it was 30,000. So the total salary will be 50,000. It means that the residual profit will just be 130,000 minus 50,000, which is 80,000. And currently, we are only preparing the current account for P. We were told that they share profits and losses equally. It means that out of the total residual profit of 80,000, half of it will belong to P. Half of 80,000 is 40,000. And profit will definitely increase the current account balance. So the 40,000 will go on the credit side. Then we have salary. P will receive the salary of 20,000. Again, it will increase his current account balance. So 20,000 will go here as well. And that should be all. Now we need the closing balance, which will appear on the debit side, since this is lower. Now the total from the credit side will be 20,150 plus 40,000 plus 20,000, which results in 80,150. Now the closing balance will be 80,150 minus 10,200, which results in 69,950. This is the answer we're looking for, which is given by option B. That's all for the 17th question. Let's move towards the next one. Which statements are correct? Capital reserves arise from normal trading activities. That is incorrect. From normal trading activities, only revenue reserves will arise. Capital reserves can be used to pay dividends. Again, this is incorrect. In order to pay dividends, we only use the revenue reserves. Revenue reserves may be used when bonus shares are issued. That is true, but we will first start with the capital reserves. And if the capital reserves are not sufficient, then only we use the revenue reserves. So 3 is correct. Revenue reserves represent profits which have been realized. That is true, because the major revenue reserve is our retained earnings, and retained earnings is just the accumulation of profit for the year. So the correct answer should include 3 and 4, which is given by option C. That's all for the 18th question. Let's move towards the next one. The following information is provided for a company for the financial year ended 31st March. We have revenue, administrative expenses, finance costs, distribution costs, dividend paid. There were no other expenses for this period. Company adds a uniform markup of 25% on all goods sold. What was the profit from operations for the year ended 31st March? So we can start with the gross profit since we have markup. Okay, so markup, in this case we have revenue instead of the cost of sales. And the way to apply markup is we just add 25% of cost as profit and then calculate revenue. Remember that revenue is just the accumulation of cost of sales and the gross profit. Now gross profit is just going to be cost of sales times markup. We have the value of revenue, that is 7,200,000. Now if we take cost of sales common, that will be 1 plus markup, which is of 25%. Now let's solve this equation. The cost of sales is just going to be 7,200,000 divided by 1 plus 25%. This results in the value of 5,760,000. This is the cost of sales. Now we know that gross profit is just cost of sales times markup. So the gross profit is just going to be cost of sales, which is 5,760,000 times the markup of 25%. This results in the value of 1,440,000. Now, profit from operations is just going to be gross profit minus our operating expenses. In this case, we have administrative expenses which we need to subtract. Finance costs will be subtracted after the profit from operations. We need to subtract distribution costs as well. That is our operating expenses. Then dividend paid, it will be paid out of the profit for the year. So we will not be including these two items. We just need to subtract these two, the 320,000 and 60,000. So our profit from operations will be, we can start with the gross profit, 1,440,000 minus the administrative expenses of 320,000 minus the distribution cost of 250,000. This results in the value of 870,000. That is the answer we're looking for, which is given by option B. That's all for the 19th question. Let's move towards the next one. Which statement is a limitation of accounting ratios? The first one is that they do not aid comparison with the business's past performance. This is incorrect. We can compare our past ratios to the current year's ratios and figure out how the business is doing. So A will be incorrect. They do not help with future decision making. This is not true because with the help of the ratios, we can figure out whether something needs improvement. So it will definitely help in decision making. They do not help with interfirm comparisons. Again, we can compare our ratios to other businesses within the same industry. So this is also incorrect, which means that the correct answer would be D. They do not take account of qualitative factors. That is true because while calculating accounting ratios, we only use the financial factors. So we ignore qualitative factors such as customer loyalty or experiences and skills of our workforce. That's all for the 20th question. Let's move towards the next one. A business provided the following information at the end of a financial period. What is the trade payables turnover in days? So the formula for trade payables turnover is just going to be trade payables divided by credit purchases times 365, since we need to calculate it in days. Now we have total purchases for the period. We have cash purchases during the period. Remember that total purchase is just our cash purchase plus the credit purchase. In this case, we need the credit purchase. So let's solve this equation. The total purchase is of 700,000. Out of this, cash purchase is of 200,000. Now we can easily get the value for credit purchases. So the credit purchases is just going to be 700,000 minus 200,000, which results in the value of 500,000. So we can just enter the value, 500,000. Now we need the trade payables as well. So we have trade payables at the start of the period and trade payables at the end of the period. In this case, all of the information is at the end of the financial period. And normally while calculating the ratios, we use the ending balance. So the trade payables should be of 60,000. This results in the value of 43.8. And whenever we are calculating ratios in days, we always need to round it up. So that will be 44 days. That's the answer we're looking for, which is given by option C. That's all for the 21st question. Let's move towards the next one. which cost will increase as production decreases? Okay, so as the number of units decreases, which cost will increase? The first one is fixed cost per unit. So I can just give an example. Let's say the total fixed cost is 50,000. Now, let's say the number of units, previously we had 100 units, now we are reducing it to 80 units. So the per unit fixed cost will be the total value divided by the number of units. So previously it would be 50,000 divided by 100, which is 500. Now, based on the new number of units, it would be 50,000 divided by 80, which will be 625. So we can clearly see that the fixed cost per unit will increase as the production decreases. So 1 is true. Then we have total fixed cost. Remember that total fixed cost will not change due to the change in the production level. It will still remain the same regardless of the number of units that will be produced. So this is incorrect. Then we have total variable cost. Okay, let's say the variable cost per unit is 20. So for 100 units, the total variable cost will be 100 times 20, which is 2000. And for 80 units, the total variable cost will be 20 times 80, which will be 1600. We can see as a result, the total variable cost is decreasing with the decrease in production. So this is incorrect because we are looking for increasing costs. Then we have the variable cost per unit. Again, remember that variable cost per unit will remain the same regardless of the change in production level. So this is also incorrect. So the answer we're looking for should only include 1, which is given by option A. That's all for the 22nd question. Let's move towards the next one. X Limited leases a piece of equipment to perform quality inspections. This costs 8,000 per annum plus 2 for each inspection performed. An inspection is performed on every 10th item produced. Production is 120,000 units per year. Which type of cost is incurred and what is the annual cost? So in this case, we have two different aspects of cost. We have a per time period cost. Time period cost will be our fixed cost. So this 8,000 is fixed cost, but we have 2 for each inspection performed. So it depends on the number of inspections, which is a variable cost. So we have fixed aspect as well as variable aspect. So it will be semi-variable, which is given by A and B. Now we need the total annual cost. So it is just going to be fixed cost plus the variable cost. We have the fixed cost to be 8,000. Now we are concerned with the variable cost. An inspection is performed on every 10th item produced. So for every 10 units, there will be 1 inspection. And we have a total of 120,000 units. So we can just utilize our unitary method. For 120,000 units, there will be 1 by 10 times 120,000 inspections, which will just be 12,000 inspections. And for every inspection, the cost is 2. So for 12,000 inspection, the total variable cost will be 12,000 times 2. This results in the value of 32,000. And that is given by B and D. So in total, the correct answer is given by option B. That's all for the 23rd question. Let's move towards the next one. A business uses the weighted average cost AVCO method of inventory valuation. During March, the following transactions took place. What is the value of inventory at 31st March? So we need the closing inventory using AVCO method. Remember, for AVCO method, we need to calculate the average after every receipt. Alright, so at the beginning date, we have 200 units at 6 per unit. So the average value is just going to be 6. Then we received 300 units at 6.5 per unit. Let's figure out the average value. So it will be weighted average. It means that the numerator part should include all values and the denominator part should include only the number of units. So the total value for the opening inventory is 200 times 6 and the number of units is just 200. Now for 14th March, we have 300 units at 6.5 per unit. So that will be 300 times 6.5. We can just add the 300 right here. So this will give us the average value of 6.3. So the average value at the date of 14th March will be 6.3. Then we issued 250 units to production. So out of the 200 and 300, so we had 500 units in total. 250 was used. So now the remaining units for these two will just be 250. Then we received 100 units at 6.7 per unit. So we have already made the issue. Remaining units is 250 and then we have additional 100 units. That is our closing inventory. because in total we can see we had 200 at the beginning, we got 300, out of which we used 250, and then at the end we again received 100 units. So the total remaining closing inventory will just be 200 plus 300 minus 250 plus 100, which is 350 units. So we need the value for these 350 units because these 350 units will be part of our closing inventory. So we can just start there. For these 250 units, we use the average value of 6.3, and for these additional received, the average value is 6.7. So we can just multiply those two together. 250 times 6.3 plus 100 times 6.7. This results in the value of 2245. That is the answer we're looking for, which is given by option B. That's all for the 24th question. Let's move towards the next one. Ammu provided the following information about a specific job to make jewelry for a wedding. What will be the price quoted for the job to make the jewelry for the wedding? So this is asking us for the selling price. Cost of materials required is 10,000. Ammu needs 10 hours at 125 per hour to design the jewelry. Let's just add up the cost. So we have 10,000 for the materials. Then 10 hours at 125 per hour. So the total rate for this labor for the 10 hours will be 10 times 125, which is 1,250. So we'll add this. Then her assistant needs 100 hours at 70 per hour to make the jewelry. So again, the assistant labor cost will be 100 times 70, which is 7,000. So we add that as well. Then fixed overheads are absorbed at 50 per labor hour. In this case, Ammu has 10 hours of labor and assistant has 100 hours of labor. So in total, we have 100 plus 10 labor hours, so which is 110 hours. And the rate of fixed overhead is 50 per labor hour, so we have 110 hours. So the total fixed overhead will be 50 times the number of hours. So 50 times 110, which results in 5,500. Then we have the markup of 20%. So let's calculate the total. 10,000 plus 1,250 plus 7,000 plus 5,500. This results in the value of 23,750. This is the cost. We need the selling price and we have a markup. We apply markup by just adding the percentage of cost as part of our profit. So selling price will just be cost plus profit. And in this case, the profit is just going to be cost times markup. So cost plus cost times markup. If we take cost common, that will be cost times 1 plus markup. Okay, so we just calculated the cost to be 23,750 times 1 plus the rate of markup is 20%. This results in the value of 28,500. That is the answer we're looking for, which is given by option D. That's all for the 25th question. Let's move towards the next one. Which statement about absorption costing is correct? It aids the preparation of budgets. That is incorrect because absorption costing will usually be for making long-term decisions, since it will calculate the overhead absorption rate based on the budgeted values. So we already need the budgets in order to perform absorption costing. This is incorrect. It follows the matching accruals concept. The main feature about absorption costing is that it will include both our variable cost as well as the fixed cost while calculating the total value for our inventory. It means that all of the costs will be matched to the revenue for that particular period, which is what matching concept states. So it means B is the correct answer. Let's take a look at the remaining options as well. It is the best costing method for managerial decision making. That is not true because absorption costing just divides the total fixed overheads based on the number of hours. A more realistic approach would be to divide it based on the activities in which the overheads are incurred. So that will be part of our activity-based costing, which we will learn more about in our second year. So that is included within paper 4. This is incorrect. Then it produces the same unit cost in the long run, whatever the output. This is incorrect because the unit cost will differ in the long run, because in the long run there might be changes to our fixed cost as well. That is why absorption costing will not produce the same unit cost in the long run. That's all for the 26th question. Let's move towards the next one. The canteen costs of a business have been apportioned to production departments 1 and 2. Total canteen costs apportioned to production 1 department were 40,200. Of these, 3,900 could be attributed to a special function by production department 1. The remainder were apportioned on the basis of employee numbers, which were 15 for production department 1 and 10 for production department 2. What were the total canteen costs for the whole business? Okay, we can understand it this way. We have the total canteen cost. and we need to apportion it within department 1 and 2 for our production department. Now, out of the total canteen cost, 3900 is part of production department 1, and the remaining will be divided based on the ratio 15 for 1 and 10 for 2. So 15 is to 10, right? Then the total canteen cost apportioned to production department 1 will be 40,200. So this will be 40,200 will be the 3900, which is for a special function for 1, and then the remainder that is being divided. So let's just denote it by R. So out of the total remainder, it will be apportioned 15 out of the total of the 25 parts, because that is the ratio. So it will be times 15 by 25. So we just need to solve for this remainder value. Okay, so remainder times 15 by 25 will be 40,200 minus 3,900. It means that the remainder value will be 40,200 minus 3,900 times 25 by 15. This results in the value of 60,500. So this remaining value is 60,500. We need the total canteen cost. Total is just the sum of these two. So 60,500 plus 3,900. This results in the value of 64,400. That is the answer we're looking for, which is given by option B. That's all for the 27th question. Let's move towards the next one. What is a limitation of marginal costing? Contribution per unit varies with output. This is incorrect because within marginal costing, the selling price per unit as well as the variable cost per unit will remain constant. It means that the contribution per unit will also remain constant, since this is just selling price minus variable cost. So A is incorrect. Then inventory valuations vary more than under absorption costing. This is incorrect because within marginal costing, the difference is that inventory is only valued at the variable cost, so we completely exclude the fixed cost. Then it can cause over or under recovery of overheads. That will happen in case of absorption costing, since there will be under absorption and over absorption. So it means that the correct answer would be D. The division of cost into fixed and variable is difficult. That is why we distinguish between our fixed cost and variable cost under marginal costing. That is true. Let's take a look at the next question. A company has the following budgeted information for me. We have the selling price per unit, variable cost per unit, and total fixed cost. The company is planning to buy a new machine which will reduce the variable cost by 20%. So the new variable cost will be the previous value 80. Now we need to reduce it by 20%. This results in the value of 64. And increase the fixed cost by 20%. So the new fixed cost will be the previous value, 56,000, and we need to increase it by 20%. This results in the value of 67,200. What is the change in break-even sales volume? Okay, so the break-even point is just going to be total fixed cost divided by contribution per unit. Let's calculate the previous contribution. It will be previous selling price 120 minus previous variable cost of 80. This results in the value of 40. So the previous break-even point is just going to be previous fixed cost of 56,000 divided by the previous contribution of 40. This results in the value of 1400. Now for the new values, let's calculate the new contribution. The selling price is not changing, so we can still use 120, but the new variable cost is 64. This results in the new contribution to be 56. Now we have the new fixed cost of 67,200 and the new contribution per unit of 56. This results in a value of 1200. So we can see that the break-even point is decreasing by 1400 minus 200, which is 200. So the correct answer we're looking for should be decreased by 200 units, which is given by option A. That's all for the 29th question. Let's move towards the next one. Why is cost volume profit analysis useful for management? Because by changing one of the factors, cost or volume, we can see the effect on the remaining factors. So it will give a more accurate value for inventory. This is not true because we're only taking a look at the changes and the impact it will have on the remaining factors. It helps with long-term decision making. That is also not true because since we are looking at the impact by changing one of the things, it will help in short-term decision making. Then it makes it easier to identify which costs are fixed. That is absolutely not true because there will be no assisting in categorizing the cost as fixed or variable. So it means that the correct answer would be D. It shows the effect on profit when a certain changes occur. That is what cost volume profit analysis is. So that's all for the 38th question as well. That is all for this paper. If you found this video useful, make sure that you like the video and leave a comment below, and make sure to subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.